Something unusual is happening behind the scenes of the global economy, and almost no one is talking about it. A quiet shift is unfolding that could reshape financial power across the world. The number seems small, 4.28%, but it's sending shockwaves through markets. That single figure is quietly affecting everything from interest rates to global confidence. Before we go deeper, make sure you subscribe to WorldScope News, because stories like this unfold fast, and staying ahead matters more than ever. This isn't just about charts or investors. It's about trust, and right now that trust is being tested in real time. For decades, U.S. government debt was considered the safest place on earth. Countries trusted it the way people trust a locked vault. But something is changing beneath the surface. And it's happening slowly enough that most people haven't noticed yet. 3 major nations have begun reducing their U.S. debt holdings. Not dramatically, but steadily enough to raise concern. When large economies make even small moves, global markets pay attention, because small shifts at the top can create massive ripples below. To understand this, you need to understand bond yields. Yields rise when investors demand more return for risk. So when U.S. Treasury yields hit 4.28%, it's not random. It's a signal that something deeper is shifting. It's like lending money to someone and suddenly asking for higher interest. That usually means you feel less secure about getting it back. Now imagine that mindset at a global level. Entire nations adjusting how they view risk. The United States has relied on global demand for its debt for decades. It allowed borrowing at lower costs to fund massive spending. But now borrowing is getting more expensive, and it's happening at a time when debt levels are already high. One major reason behind this is inflation. Rising prices forced central banks to increase interest rates. Higher rates naturally push yields upward, but that's only part of the story. Geopolitics is playing a bigger role than before. Nations are thinking more about independence and control. Some countries want to reduce reliance on the U.S. financial system, not out of panic, but long-term strategy. This is where diversification comes in. Instead of relying on one system, they spread their assets. That includes shifting into gold, other currencies, and different investments. Quiet moves, but powerful ones. These changes don't happen overnight. They are slow, careful, and calculated, and that's what makes them dangerous to ignore. Because by the time it's obvious, the shift is already done. Now let's look at bond prices. When yields rise, bond prices fall. That means countries holding older bonds lose value, and that creates pressure. Do they hold and wait, or sell and reposition? That's the dilemma. Some nations are choosing to sell. Not everything, but enough to matter. When multiple countries do this together, the effect multiplies. Prices drop further and yields climb higher. This creates a feedback loop, and once it starts, it can accelerate quickly. Now here's where things get interesting. Higher yields attract new investors. Investors chasing better returns start buying U.S. bonds again. That supports demand. But at the same time, the U.S. dollar strengthens, and that creates global pressure. A stronger dollar makes imports cheaper for Americans. But exports become more expensive. Emerging markets feel this even more. Their currencies weaken, and debt becomes harder to manage.
So a change in U.S. yields becomes a global chain reaction, one shift affecting many economies. Back in the U.S., higher yields mean higher costs. Mortgages, loans, and credit become more expensive. That slows down spending, and when spending slows, economic growth can weaken. But there's another side to it. Higher rates help control inflation. So policymakers are stuck in a balancing act. They must control inflation without hurting growth too much. It's a difficult position, and every decision has consequences.
Investors are watching every move closely. Even small signals can move markets fast. Uncertainty is the biggest factor right now, and markets don't like uncertainty at all. So why are these nations reducing U.S. debt? There isn't just one answer. Some reasons are financial, others are strategic and political. It's a mix of short-term pressure and long-term planning. And that combination makes it powerful. This isn't about abandoning the US overnight. It's about slowly adjusting positions. Think of it like shifting weight rather than jumping, controlled but meaningful. And over time, those small shifts add up. They change the bigger picture. Now here's a question for you. Do you think this is temporary or the start of something bigger? Drop your thoughts in the comments below, because this conversation is just getting started. Let's go deeper into the numbers. US debt continues to grow rapidly. More debt means more bonds need to be sold, and that requires buyers. If demand weakens, yields must rise to attract investors. That's basic economics. Supply goes up, demand softens, prices fall, yields rise. A simple but powerful cycle. Even now, demand for US debt remains strong overall. But the margins are shifting, and in finance, small margin changes can lead to big outcomes. Think of it like a slow-moving tide. At first, nothing seems different, but over time, the shoreline changes completely. That's what's happening in global finance. Quiet, gradual transformation. These early signals are what smart investors watch, because they reveal future trends. Now let's talk about stock markets. Rising yields can create pressure on stocks. Why? Because investors compare returns between assets. If bonds offer safer returns, some money moves out of stocks. That shift can push stock prices down, especially during uncertainty. We've seen this pattern before, but this time feels different, because global conditions are more complex now. Supply chains, politics, and inflation all collide. That makes the situation harder to predict, and more sensitive to change. Now imagine yields keep rising, and more countries keep reducing holdings. At what point does it impact everyday life? That's the big question. Because eventually, these changes reach consumers through loans, jobs, and prices. Gradual change is manageable. Sudden shocks are not. That's why the 4.28% level matters. It's not just a number. It's a signal of deeper concerns building beneath the surface. But not everyone sees this as a bad thing. Some investors see opportunity. Higher yields mean better returns for new investments. So while some are stepping back, others are stepping in. That's how markets find balance, at least for now. But balance doesn't mean stability. It just means forces are equal, for the moment. And that can change quickly. So what should you watch next? Keep an eye on yield movements. Watch how major economies adjust their strategies. Follow central bank decisions closely. They hold a lot of power here. These signals help you understand where things are going before headlines catch up. Because by the time it's in the news, the biggest moves may already be done. That's how financial markets work. They move before the story becomes obvious. Right now, we're still early in this shift. And that's what makes it important. Because early awareness creates opportunity. Now think about this. If trust in US debt weakens, what replaces it? Is there another system strong enough to take its place, or do we move toward a fragmented financial world? That question could define the next decade. Because this isn't just about bonds, it's about global financial power, and that power is slowly being tested. Not through crashes, but through quiet, steady change. If you found this video valuable, share it with someone who follows global markets. Because understanding these shifts early can make a huge difference. We'll keep tracking this story as it develops, because what happens next matters. Make sure you stay connected with WorldScope News, because we break down what others miss. The real question isn't whether change is happening, it's how big that change will be, and whether the world is ready for it.